TROW price is historically a very great dividend stock. Had a great run during the pandemic, came crashing down, and are still below those levels. Meanwhile, revenue is back to normal growth mode, and earnings per share has also recovered well. So when you would maybe look at it, this is currently yielding $9 in earnings per share, $94, around a 10 multiple, plus a 5 dividend. What could go wrong here? Let's look into it, why I think there are some big concerns with TROW. TROW is an asset manager. They have mutual funds, 401ks, retirement accounts. They also have normal trading, Roth IRA, traditional IRAs, 401ks, basically everything that comes to retirement. Some of it is corporate, some of it is personal. Roth IRA is personal, 401k is by your company. They also have general investing, stuff like college savings. All of these are these assets under management. Of course, that means assets under management go up and down when the market goes up. However, now they're growing again. Now, what is the big concern here? When we look at the net flows, so basically what is paid in, what is paid out, ignoring the underlying market change. Ever since 2021, they bled heavily. And if you look who is paying in that money and is taking it out, institutional is still paying a bit in, also flowing out, but retail is only taking out. This company is currently losing its retail customers. Their revenues are still going up. It's based on assets under management. So it doesn't matter how much money is taken out, as long as this number goes up, they will be fine for now. However, when you're slowly losing in this segment, the retail segment, and your only hope is institutional, which is also slowly taking money out, then there's an issue. Now, what does it mean when we're losing retail money? No one is really using TROW price as a broker anymore. Look at these terms. Minimum investment, 2,500 euros. People are using Robinhood, Webull, other low-cost products. Especially younger people do not invest over these things anymore. So if you're generally investing, you don't go with TROW anymore, unless you're a very old person who already has their account on TROW, because these terms are incredibly bad. Roth IRA, also other stuff like Robinhood, are so competitive. 3% match on annual contributions with Robinhood Gold on IRA match. Cheaper trading fees. TROW is just not competitive. So if you're personally investing in a Roth IRA, this is also difficult. Now, what about 401ks? This is where they're still doing great. This money, institutional money, does not care really about the underlying fee structure. They want to have a 401k set up for their employees, say, hey, we have a 401k that you can invest in. Most employees, I don't want to call them stupid, but they're financially literate. They do not care. They know, oh, 401ks for my retirement, sure, that's nice to have, let me get it. Of course, you're going to have a few people who are like, oh, let me look into it, or I would rather have it paid out instead. But this money is going to move slower than everything else. This money is around 5 years ahead of this money. And once you have employees complaining about their 401ks at the company, and if the company switches the underlying 401k company, then it's when TROW price is in trouble. Because if both of these take a lot of money out at the same time, then the assets under management are going to start shrinking. TROW was saved by a market that's recovering. What if a market would have flatlined for 3 years? But it's not unusual. S&P 500 from 2000 to 2012 hasn't moved at all. Zero. Imagine for 12 years, while assets are flowing out, then all the assets under management are gone. Now, what also plays against TROW is that 401ks are going to be less profitable. People are getting older. The average age is way, way higher now than it was some time ago. And that means less people going into 401k, more people paying out their 401k for retirement. So TROW price is being hit double. Their brokerage platform is not competitive. They would have to cut fees massively there. 401k, they still have those companies clinging to their 401k companies because they honestly don't care. You're going to rely on the 401k staying there and on the market going up. If it stays going up, that means you still get this revenue growth. You get this slightly increased dividend per share. As long as the market does well, revenue is going to go up. For the majority of customers, TROW is not the first option, not even the second, not even the third. And this is what happens then when the market's in a downturn. And if that continues, I'm not saying the market is about to pop. I'm not saying anything. However, even if a market moves sideways or very slowly, TROW loses revenue. Now, they're not at risk of going bankrupt. They have 2.3 billion. What TROW could be doing is buying other companies. Maybe buying some smaller brokerages, integrating them. Maybe they can do some small acquisitions. Or even buy back their own shares. 2 billion, that's 10% of their company right there. What is the play of this company? You still have this currently good EPS. And if the market continues to grow for the next few years, you're probably gonna see a development there. Maybe eventually it's gonna flatline. TROW really doesn't require a lot of money to be thrown into a business. It's very capital light. Sure, you have your employees set up, but once you have a profit, you don't really need to reinvest it much. So let's say you just get this $9, you pay out 5 in dividends, that leaves maybe 4 in buybacks. That will give you around a 4% buyback yield. So what are our scenarios here? I will play with a scenario where the market moves up. The withdrawal doesn't speed up. TROW's revenue grows at 4%, plus 4% buybacks. Now, however, after 5 years, more people are going to have retired. 401ks is going to be a worse business. Private brokerage, they're not really that invested there. So revenue is gonna grow down to 2%. After that, it would maybe decline, but then you would need to look again. Good dividend payers usually get a higher multiple. That's just how the market goes. Let's say you get a 12 multiple a year. They pay out 60% as dividends. With that, you would get $120 per share. That is a 28% upside. However, you rely on a good performing market for 10 years. Now, what if it goes very well? TROW recovers. They gain market share in private retirement accounts. Because private retirement accounts growing faster than 401ks, Roth IRA especially. They improve their brokerages, maybe onboard more companies for 401ks, or they just gain more popularity. 11% growth, 4% buybacks, 8% plus 4%, 18 multiple. Then you would get to 250. Now, this is very exuberant. This assumes turnaround of a business, which I don't think is going to happen anytime soon. Now, what if a bad scenario happens? The stock market goes flat or crashes. Underlying assets shrink. You only get a bit of buybacks, 8 multiple, because it's not a good company, $66 a share. And this is not even the horrible scenario. You can see what happens to TROW's earnings per share. It tanks. And if it wouldn't have recovered, it would still be tanking even further. If a market tanks completely, more and more money gets withdrawn year for year, this could very well be a zero. So this is a very risky company. You really need to watch out how's the company developing. I will put it on my watch list. I will look how the company develops, how the products develop. But right now, it's more on the sidelines. It's a risky stock. What do you think? Write down below. Have a good day.